was wholly owned subsidiary of Baroda Stock Exchange Limited, appointed by Security Exchange Board of India as a public representative director. He is also serving as a director of Hingoria Foundation and a managing committee member of Baroda Chamber of Commerce and Industries. He was ex-associate professor in the Department of Accounting and Financial Management, Faculty of Commerce, MS University, Baroda. In terms of qualification, he started accountant, ICWA, MCOM, and also have done PhD with a thesis on working capital management. With this brief introduction, I would like you all to please welcome K. Dr. Alok Shah with a big round of applause. And I would like to request the past chairman of the branch, Sanjay sir, to please welcome the faculty with a bouquet and a memento.
Good morning, friends.
Good morning.
It's a pleasure for me to be among the professional brothers, wherein I always love to share my thoughts. I'm not an expert, but I'll try to share whatever little knowledge I have on the subject which has been given to me. Just 4 days back, I got a call from Mr. Khandelwal requesting me to speak on the subject. And as I have told you, it is always my pleasure because I have remained a teacher for more than 25 years. So I thought let me go back to Ahmedabad, wherein I have not spoken for last almost more than 10-12 years. So I got this opportunity once again. So I thank Ahmedabad branch and the study circle to give me this opportunity. So thank you, Mr. Khandelwal, for be kind enough to allow me to share my thought on this particular topic. Friends, let me tell you that the LLP as a form of organization is still evolving. Almost about 8 years back, when this act was introduced, there was a lot of enthusiasm in the professional circle as well as in the business community that this particular form of organization will bring in a lot of changes in the times to come. But it took, I think, 8 years plus, maybe another 4 or 5 years down the line, which I personally feel is going to take, that people will be able to understand the immense benefit which is going to be with this particular form of organization, which is basically a limited liability partnership. When I was just trying to go through the history of the limited liability partnership in the other parts of the world, I was looking at the history that in the early 80s, it has started in the Europe, US and the UK. And very interestingly, in fact, before US and UK, before US and Europe, the UK was the first country to bring the act in the form of a limited liability partnership. And with that particular aspect in mind, let us try to understand what is LLP before we go to exactly the subject in proper about the taxation. My general viewpoint is that before we understand the taxability, we need to understand what is the type of the organization, what are its implications, and how it is going to have the effect on the taxation at a later point. So first, let us understand what is a limited liability partnership is all about. Friends, as you know that this is a hybrid of a partnership and a company. For large number of years, for almost I will say more than 2 centuries, we kept on dealing with a partnership firm per se and a company form of organization. As you know that the company form of organization evolved during the Industrial Revolution in the 18th century. What has happened that the people were feeling that there should be some mix of it, wherein the benefits of the partnership and some benefit of the corporate form of organization should be available. And with that particular idea in the mind, this form of organization has evolved. Friends, let me tell you that whenever we as a professional, personally our firm and me in particular, whenever we try to look at this form of organization, we try to understand that what are the intricacies, how it is getting evolved, and personally we also need to understand and we have to get ourselves interested into it. And from that viewpoint, I would like to tell you that for us as a chartered accountant in the times to come, many of the chartered accountant firm earlier were practicing in the firm name, now they have converted into the LLP. Our own firm, we have also converted into the LLP. Now what is basically going into the, the limited liability partnership, if you look at, there are number of advantages, and I personally feel that most of the professional firm which is now going to come up, even they will be also in the form of an LLPs. It is basically considered as a firm for all taxation angle. If you look at the Income Tax Act, it is very clearly defining that for all purposes, the LLPs are going to be assessed as a partnership firm only. It limits the liability of the partners. So by and large, we have been always dealing into the Partnership Act 1932, wherein we know that the liability of the partners are joint and several. While when we talk about the company, we know that the liability of the company is limited. As I have told you, this is basically a hybrid. So the concept of the limited liability is brought in to the partnership firm, and that is what is a limited liability partnership is all about. So the liability of the partner is limited to the extent of their capital contribution. There are various tax advantages as compared to the company, which we will see little later. It is governed by the Limited Liability Partnership Act 2008 and further Limited Liability Partnership Rules 2009. So it is not a very old act. In fact, as soon as this act was introduced, Baroda, Ahmedabad and everywhere in the India, all the professional institutes, they have the various seminars on these acts. But as I have told you, it is basically still not been very popular among the professionals. It is a body corporate. The reason being is that it is basically going to be registered and you will be getting a certificate of incorporation. And it has a separate legal existence, unlike a partnership firm. As you know that a partnership firm under the Indian Partnership Act 1932 don't have a separate legal status. It is basically an association of a partners. It has a perpetual succession, just like a company. A classical example of a Solomon versus Solomon would also come over here, which we have already studied way back, maybe almost 20 years back or 25 years back. Liability of the partners, as I have already told you, it is limited. And one very interesting aspect, which is having a distinction between a partnership firm per se and a LLP, is that in case of a partnership firm, partner is an agent of a firm as well as he is also representing the other partners. So supposing there are 4 partners, then A, B, C and D, then A is representing A, B, C, D and company, a firm, and also representing other partner B, C and D whenever he is acting. While in case of an LLP, he is representing or agent of a firm only and he is not representing the other partners. So that is again a distinction between a firm and a LLP. Now who can be a partner? So basically the limitations are there in the partnership firm. As you know that we have already been knowing this since ages, that the firm can always have a maximum 20 partners other than a banking business and 10 partners for a banking business. While in case of an LLP, there is no restriction. You can have any number of partners. There is no limit, but minimum 2 persons are required because it is always indicating a plurality. Whenever we talk about an LLP, it always indicates a plurality. Who can form LLP? An individual or maybe one or more individuals, all can be individuals. even a non-resident can also become a partner in the LLP. This is very much very essential because now you have also a OPC, one-person company. In one-person company, if you can recollect, a non-resident cannot become a member of the OPC, right? Because that is very clear mandate in the Companies Act 2013 that a one person who is forming a OPC cannot be a non-resident. Unlike that, in case of an LLP, you can have a non-resident partner as well. A body corporate, that is, let us say a private limited company or a public limited company, can become also a partner of the LLP. Company incorporated in or outside India and LLP incorporated in or outside India. See, basically LLP, one LLP can become a partner of the another LLP as well. Because as you know that an LLP is a separate legal entity. Once you are conferred with that legal entity status, you can become a partner. For your information, that is very clearly mandated even under the Indian Partnership Act. A partnership firm which is not a legal entity cannot become a partner as a partnership firm in another partnership firm as well. But LLP can become a partner in another LLP as well. Who cannot become a partner? An HUF cannot become a partner of the LLP. A Karta representing HUF cannot become a partner. But a Karta in his own capacity can become a partner. But he is then not representing a HUF. So one need to understand, supposing I am Alok Shah having an HUF, Alok Shah HUF cannot become a partner. Karta of HUF, Alok Shah cannot become a partner representing HUF. But Alok Shah in the individual capacity can always become a partner. A minor, unlike a Partnership Act 1932 which permits a minor can be admitted to the benefits of a partnership firm, which is very clearly provided into the Partnership Act itself. So as you know that a Contract Act clearly restricts or prohibits a minor cannot be a part of the any agreement or a contract. But exception to that is there in the Partnership Act 1932 that a minor can be admitted to the benefit of a partner. So we know that he can share the profit but he cannot compelled to share the losses. But there is a clear restriction under the LLP Act that a minor cannot become a partner of the LLP. A partnership firm cannot become a partner of the LLP. An association of a person or a body of individual. An artificial juridical person, like you have a trust or basically a deity of the, like a goddess, wherein you have created an artificial entity that cannot become a partner. A corporate soul, a cooperative society registered under any law for the time being in force. A body corporate which the central government may by notification in the official gazette restricts or specify in this behalf cannot become a partner. So basically these people or this type of the entities cannot become a partner of the LLP. A capital contribution. Most of the time we have the impression that once you have an LLP or once you have a partnership, a capital contribution is mandatory. Though the Limited Liability Act 2008 nowhere specifies that every partner has to contribute, but let me tell you, this is again an opinion where it is not necessary that every partner has to contribute. It is not mandatorily required under the Act as well. You can have a capital contribution ratio different than the profit sharing ratio. Again, it is legally possible. These all have the impact on the taxation, and therefore we need to understand all these points as well. Because sometimes what happens that without understanding the basic background, we try to jump to the conclusion. See, sometimes you can plan out also based on the capital contribution and the profit sharing ratio. A lot of people then when talk about the direct tax impact, we have understanding that this is possible, this may not be possible. So normally we understand that the capital contribution and the profit sharing ratio would remain same in case of a private limited company or a public limited company. But it may be different in case of an LLP. and that leads us to a tax advantage. So maybe a father and a son having a same amount of the capital contribution can have a different profit sharing ratio as well. Contribution can be in the form of a tangible, intangible, movable, immovable property. Monetary value of the contribution of each partner to be accounted for, like supposing a partner is bringing a intangible or tangible asset into the firm, then you can pass an entry in the books of account with the value assigned to that tangible or intangible, movable or immovable properties. The disclosures require that the contribution to be accounted for and disclosed in the nature of contribution and amount, and contribution of the property or contribution in the nature of tangible or intangible, it is required to be valued. It can be valued by a chartered accountant or a cost accountant or an approved valuer. So that is again mandatorily required that whenever a partner is bringing in LLP any form of an intangible or tangible asset, it is required to be valued first and then you have to account for it. So we now come to the accounting part. The limited liability partnership, unlike companies, wherein under the Companies Act you are mandatorily required to follow the mercantile or accrual system of accounting. In case of an LLP, you can follow either the cash or accrual method of accounting. And see, basically these are the flexibility which is available to the LLP, and that is what I want to share with you, that it gives you the tax advantage at some point in time. Like many of the now chartered accountant firm or even the consultants, they are forming LLP as well for this particular reason only, that they have the flexibility to follow the cash method of accounting in their books or under the income tax as well. Rule 24.1 and 24.2 of the LLP Act 2008 is in connection with the maintenance of the books of account or accounting records. One of the requirements of the LLP Act is that the statement of account and solvency for the financial year, every year financial year end, and you are supposed to file with the MCA. Ministry of Corporate Affairs is again the ministry who has been given the power to regulate and register the LLP. So on the same website you need to upload the accounts of the statement of assets and liabilities, statement of income and expenditure, and a certificate by the auditor. Now let us try to understand the tax aspect of the LLP. So now we go to the tax aspect. The Income Tax Act 1961 very clearly states that in the definition itself of a partnership firm, that the partnership firm includes the limited liability partnership. So wherever the word partnership or partnership firm is used, we need to understand that it automatically includes the limited liability partnership firms as well. So for all practical purposes, the assessment and the tax treatment of the firm is identically applied to the LLP as well. Section 223 of the Income Tax Act states that the phrase firm and the partner to include LLP and its partner, as I have told you. Partner's share of profit will be exempt. As we are treating the LLP as a partnership firm, automatically the share of the partners derived from a partnership firm will be automatically exempt under section 10(2)(a) of the Income Tax Act. Designated partner. This has little distinction between a designated partner and a partner. The LLP Act has very clearly mandated that at least one of the partner out of all the partners of the firm should be designated partner. But supposing a partnership deed or the firm filed with the MCA do not specify the designated partner, then all the partners are deemed to be a designated partner. Now sometimes we wonder that why the designated partner is important. Friends, the liability of the designated partner per se is more, and basically specifically when you talk about a prosecution and a penal provision, the liability of the designated partners are enormous. So we need to understand that in most of the cases a designated partner would be there in the firm, or it would be required to be mandated, and under the Income Tax Act the designated partner is supposed to be a partner in charge and he is supposed to sign the tax return and the forms. Now one clear distinction which I want to share with you is that, because we are many times trying to mix up the word, designated partner need not necessarily be always a working partner. He can be a non-working partner as well. A designated partners generally are the working partners, but it is not necessarily to be done so. There would be a joint and several responsibility of the partners to make the payment of the tax. We are going to see the tax aspect and the responsibility of the partner so far as the outstanding liability of the tax little later in those slides. LLP incorporated outside India will not be treated as a firm under the Income Tax Act. So this is very important. I am repeating again. LLP incorporated outside India will be treated as a company, and the tax treatment under the Income Tax Act is not that of the firm. So only the LLP incorporated in the India will be treated as a firm. Now what are the tax implications when we say that the LLP is a firm? The natural corollary would be that as a partnership firm, when you can give a remuneration to a partner which is allowable under section 40B, and the interest on the capital of the firm can also be allowable under section 40B. So on the same line, the LLP is also entitled to get the deduction of the payment of the remuneration to a working partner subject to the ceiling under section 40B. And what is that ceiling? We know about it, that on first 3 lakhs you get 90%, and if it is less than 3 lakhs or there is a loss, you get maximum of 1,50,000 rupees, and on the balance amount of the book profit you get 60%. This is the maximum amount. Now most of us are aware about it, that some of the points you may find a repetition, but I want to hammer because some we may miss out. And specifically I have seen without being critical of the other professional, that those partnerships which are drafted by other than chartered accountant, they miss out on the remuneration clause, they'll miss out on the interest clause. It is mandatory under the Income Tax Act that unless it is authorized by the deed of the partnership, the partner's remuneration and the interest on the capital will not be allowed. So you need to incorporate that, and that is mandatory. If it is not there, then that deduction you will not be able to claim, and accordingly your tax liability may go up. In case of a company being a partner, and wherein you have the dividend, you can reduce it from the book profit. Coming to the TDS compliance. No TDS under section 192 on the remuneration to a partner of the LLP or a firm, who can be even a designated or a working partner. No TDS under section 194A for the interest paid to the partner. Non-resident partner non-resident partner, see, this is very interesting. A non-resident partner, this is very unusual, and therefore I have considered it appropriate to take it. TDS under section 195 for payments made towards interest and remuneration paid. As friends, you know that all the payment to a non-resident is governed by section 195 of the Income Tax Act. So we have to look at the section, because that section starts with notwithstanding clause. So when there is an abstinent clause, you will have to consider that will override 192 and 194, and therefore we have to deduct a TDS on the interest and remuneration paid to a non-resident. These are the things which are very small, but it can be missed out, and therefore I consider that we have to understand it. To a firm, right?
Now development right has been paid
Right,
to partner.
right. See, basically, in my personal opinion, that is a separate commercial transaction, and as it has not come as a form of a capital contribution, that will be basically not going to be governed by these provisions. And you will have to deduct, in fact, the TDS on it. And if you consider that is basically a right in the immovable property, then 194 IA would also be applicable. Unless the partner brings it in the form of a capital, then the whole provision would be different. Then you can claim the interest on the same and everything would go accordingly. Development rights, in my opinion, it will be commercial separate transaction, and you will have to deduct the tax accordingly. The point which you were trying to bring is indirectly covered. 45.3, which is introduction of the capital asset by partner into the LLP. The same identical provision is there for the firm as well. Whenever the partner brings in into the capital asset, the asset as a capital into the firm, like let us say a partner is bringing a land or a office or a building or even a plant or a machinery into the firm, that can go as a capital, but it will considered as a transfer, and on that particular transaction the taxability would come in the hands of the partner. The section very clearly mandates that the value at which it is recorded in the books will be the consideration. Why I want to tell you all this? Because sometimes we miss it out. And just because we want to plan out something, we may miss out. Just to give you an example, supposing a land worth 50 lakhs is introduced as a capital in the business with a value of 1 crore, because that is required to be valued, as I have told you, either by a chartered accountant or a cost accountant or a valuer. So supposing if that value comes on the date of the introduction of the capital as a 1 crore, then on the difference, the capital gain tax liability would come in the hands of the partner. I am not covering here the capital asset converted into stock in trade. That is a separate topic by itself, and as you know that it has the separate implication. Okay. Distribution of the capital asset by LLP on the dissolution or otherwise. Again the same treatment like what you have in the firm. Whenever the distribution takes place, at the time of the distribution, see the word used in the act, and in fact I don't remember the citation. When maybe Chintan Bhai can help me, because I think he's very good in this citation.
Really don't.
But I tell you that you have covered some of the points which I had a plan to take up. So, no, that's good. In fact, you have made my work easier. So what happens that when you are distributing at that point in time, the tax incidence is going to arise, not at the time of the dissolution. That is what is the citation is all about. Friend, try to understand there is a time gap, or there can be a time gap between a dissolution of a firm and actual distribution per se which is going to take place. The liability or the incidence of the tax is going to arise at the time when there is going to be a distribution of the assets, right? So we need to understand that. Section 78(1), which is about the carry forward of the losses in case of a retirement or death of a partner, which I understand that Chintan Bhai has also indirectly tried to cover. That to the extent of the amount of the loss pertaining to the retiring partner or deceased partner, you will not be allowed to be carried forward. That is what is section 78(1) is talking about. I think I am clear. Supposing there are 4 partners, A, B, C, D, all are sharing equal, 1/4, 1/4, 1/4. Then to the extent of the 25% of your business loss, I am talking business loss because Chintan Bhai was very clear when he was talking about the loss, that it is always talking about the business loss. Depreciation is a separate. There is nothing to do with the business loss. So only to the extent of the business loss, you are not entitled to carry forward. So far as depreciation is concerned, it has nothing to do with the retirement or the death, right? So that in any case you will be able to take. Section 115 JC talks about the alternate minimum tax. In fact, I do remember in our firm we talked about lot as soon as this LLP as a form of organization emerged, and I think Chintan Bhai is here, he can even endorse me. A lot of consultants, they started advising the closely held private limited company, typically the investment companies, to convert it into the LLP. And let me tell you, a lot of people did it also. But with the sole intention that you can avoid the minimum alternate tax, MAT, which was applicable to a private limited and a public limited company, a company form of organization. But later on the government realized that it is a loophole, so they immediately plugged. You know, that reminded me a very funny thing which I would like to share to make it little lighter. That most of the time, whenever people start using it, the government will come all of a sudden and will try to plug it as if they are after you only. And when you use it, by the time I'll try to take little liberty. The big four will try to keep on applying to all the larger entities, and when you come to apply to your smaller entities or the medium-sized entities, it will be immediately known because every left, right, and center the people will use it, and the government will try to plug it. So by that time the benefit is gone. Morning only, when I was traveling from Baroda to Ahmedabad, I got a message from our partners' WhatsApp. WhatsApp is very common, so I think in every discussion we need to have some WhatsApp talk. So I received a message that one of our partner, who is a direct tax partner at Mumbai, today there is a representation before the Ishwar committee. So the Chamber of Income Tax at Bombay, they have a meeting with the Ishwar committee. I think Ishwar committee, we all know that which has been given a task of simplifying the income tax law. So another partner commented, Himanshu Bhai Kishanwala, that we should recommend to the Ishwar committee that scrap the income tax act as a whole. So I don't know, some of our friends might look at that we will have a loss of opportunity, lot of loss of opportunities, which is not going to happen, friends, believe me. Because the last time I do remember when Jaitley talked about in the budget speech, the Ishwar committee, because of the recommendation of the Ishwar committee, we want to simplify the section 14A, and they messed up, rather I would say, they increased the liability. Typically I tell you that is a very classical example that how the bureaucrats and the minister try to take the advantage just using the name. Earlier the disallowance was 0.5%. Now they made it 1%. So many of the companies which have just a dividend income, and specifically the investment company, I tell you, they are going to have a very huge tax burden in the next, this current financial year, just because of this change. So sometime even the name of the judge who has been given the task, Ishwar, is a good name, but I think even he will not be able to, Ishwar पण help नहीं करी सके आपला to reduce the tax. So just on the lighter side to make the, avoid the monotony. This is very interesting. In fact, let me tell you, to be honest, I tell you, when I was reading and my assistant was preparing, I was just looking at 184, that a certified copy of the LLP agreement. I was worried when I was looking at this particular section. The reason being is that if you have not filed along with the return of income the certified copy of the LLP agreement, the LLP is going to be assessed as an association of a person. So you are subject to the maximum marginal tax rate. But the most frightening is that you are not entitled for any remuneration and interest on capital. When I was reading, I was little frightened that now there is an e-filing, and how should we file the certified copy of the LLP agreement? And not only that, whenever there is an amendment, every supplementary or amended agreement is also required to be filed every time. But now when I was just trying to read the clarification, that gives me a solace that because of the e-filing, you have to keep that ready to submit. So whenever the assessing officer is asking you, you can submit it. So this is, as I have told you, I am not an expert. I have just little known more than what you know, because I have prepared in last 2-3 days after Mr. Khandelwal gave me the opportunity. So I always consider it is a blessing in disguise, because some of the corner points, I tell you, this is my honest submission and admission, that there are certain corner points which you will be able to know only when you listen to this type of the seminar or an expert like Chintan Bhai, or when you actually prepare for it. And this is what, as a teacher or what as a student of any subject, I would say, I have learned over the period of time. And frankly speaking, this was not known that if you don't file, you are basically losing the entire benefit of the LLP or a firm. This is the same clause like what we have in the partnership firm as well.
Like before, 11, 12.
Yeah.
And 12.
Yeah. Now I talk about the conversion, a time to change, partnership to LLP. There are a lot of tax implications whenever you are changing. Some of which are fortunately covered by Chintan Bhai. Chintan Bhai, I will keep on using your name and I will encash it, rather I will say.
He will charge brand penalty.
Cashing and charging both. Branch to him personally.
The conditions which are prescribed in the second schedule to the LLP Act, section 55, I am talking, sometime it is overlapping, so I am clear. I am trying to clarify that when I am trying to talk about section 55, here section 55 of the LLP Act. Partners of the LLP to only comprise of the partners of the firm and no one else. If there are 4 partners, A, B, C, D, then only they are supposed to be the partners in the LLP, not any other person like E or X, Y, Z, U joint. No. Later on, yes, you can do so. On and from the date of the registration specified in the certificate of registration, LLP comes into the existence. As LLP comes into the existence, automatically the firm is deemed to dissolve. Right? All property vested in the firm, all the assets, interests, rights, privileges, liabilities, obligations, these are very important because he also mentioned about it. So rights, privileges, assets, all, they are going to vest into the LLP. Right? It is going to vest into the LLP without further assurance, act or deed. This is very important, though it is not my expert area, but because they are going to be automatically vesting, in my personal opinion, the stamp duty is not going to be attracted because it is automatic by reason of the law, right? So automatically all asset will get transferred. Firm deemed to be dissolved. Now there are certain points which has come to my mind and I am trying to just mention before you, some of which are basically controversial as well. So maybe we may not have actual 100% right answer to it. Whether automatic vesting is by operation of the law, whether a transferor or transferee is subject to the any tax issues, when you meet with all the conditions, even the Income Tax Act also permits, we are going to discuss that section, there is no transfer which is taking place and so no tax liability which would arise. Continues to remain a partnership firm under the Income Tax Act because of the reason the section 2 itself is trying to be clear that LLP is a firm, so your status do not change. Your status would always be a firm. Carry forward of the AMT credit is a controversial area. That is what Chintan Bhai talked about. In my opinion, the AMT would be allowed to be carried forward because all right per se is going to be transferred to the newer firm, new LLP which is formed now. So you will have the eligibility to carry forward the AMT credit. Same PAN number. Now this is technical or this is literally practical also sometimes. In fact, in our own firm we did it. So you can have the same PAN as well, right? So sometimes some of these practical aspects we don't know unless we do it ourselves. Because nowhere in the Act it is mentioned, because these are all technical things wherein we come across only when we actually do it, right? So you can continue with the same PAN. See, these are very small things, but I tell you practical difficulties. Like supposing if it is not the same PAN, how you will be able to get the tax credit because the firm is going to be converted during the year or maybe even at the end of the year you are going to carry forward those tax credit. So all those complications or the practical difficulties they are going to arise. So you have the same PAN number continued, so we can avoid that difficulty. This is a circular on 3rd June 2010. Oh, sorry.
So just a second is coming.
10 will also remain the same.
Yes, in my opinion, the 10 will also remain the same.
If the name of LLP is different, then
Doesn't matter. If it is a conversion, it will remain the same. Though it is creating an anomaly because you know that how alphanumeric that PAN number is being formed, but it will remain the same. It will remain the same. I don't know. In case of our firm, we also had a little change in the name, but there was no change in the PAN. These are all practical things. As I have told you, nowhere in the Act it will be mentioned, and they have also the difficulties because your name and the firm name may not change later on. Supposing if there is a drastic change, somebody would question after 10 years કે તમારા ફર્મના નામમાં તો આ છે જ નહીં, later તો આવ્યું કેવી રીતે? How you got this PAN number as well? So those difficulties are going to come. So I think this is basically a transition thing which is happening. So we need to also understand that these are problems which are going to come. In fact, the same problem like supposing you change the name of the company itself. Like earlier the company is XYZ Limited, now you want to change it to PQR. So name of that company changes does not mean that the PAN of that company would change.
no, but name of the company will be changed in the PAN then later.
So that PAN card you will have, see PAN card is to be reissued, I am talking PAN number. PAN card in any case you will have to reapply. It's a correction of the name.
So same thing cannot apply in LLP.
That is what I am telling you. I mean it. That is why I gave you that example itself. I am not saying that card per se is a physical thing. Card is a physical thing. Card in any case you will have to get new. नहीं तो बद्धा कैसे कि आ कार्ड पर तो तमारू नाम LLP लख्યું જ નથી. How, why should I take this card? So in any case you need to apply.
Correction is solicited.
Yeah, correction. As an LLP and a general partnership is being treated as equivalent except for the recovery purposes in the Act, which we will discuss. The conversion from a general partnership firm to an LLP will have no tax implication. Right? If the rights and obligation of the partner remain the same after conversion, and if there is no transfer of any asset or liability after conversion, if there is a violation of these conditions, the provision of section 45 shall apply. I have taken one case, it is a very famous case, because I think Chintan Bhai was taking case law, so I thought at least let me take one such, so which I have taken. Company to LLP, a reverse. Somebody asked me in between, I don't have the answer to that, but I think I need to raise that point from the dais. I don't have the answer, to be honest, I tell you, that somebody want to convert from LLP to a firm. LLP is already formed and he want to reconvert. The Act is not having the answer to it. But I don't know whether it would be possible or not. Chintan Bhai is here, some of the senior members are here. They can add to this my view. My personal opinion is that it is not possible. You will have to form a new partnership firm to buy out the assets and liabilities of the LLP. This is what is my personal view. I may be incorrect, but this is because the Act, LLP Act, nowhere mentions this type of the situation. Reverse is there, but from private company to LLP. So therefore, I have deliberately made this reverse also. That LLP is formed from the private limited company. Section 56, 57 of the LLP Act and the third and fourth schedule deals with it. All the shareholders should become the partners and no one else. If there are 10 shareholders, those 10 identical set of shareholders have to become a shareholders or the partners of the converged or the converted LLP. No security interest in assets subsisting. On and from the date of the registration, LLP shall come into the existence. Naturally, the company will stand dissolved. All property vest into the company, all rights, liabilities, everything. Company shall be deemed to be dissolved.
Sir, as you show conversion of company into LLP, can that company cannot be converted into LLP if it is a closely held?
Pardon? No. Can you repeat? There is a company like ABC Private Limited.
Private limited.
And you want to
Closely held
convert,
company.
right? And you want to convert it into
LLP.
that is what I am talking about. No, that is what I am talking about. If you look at, I am talking on that particular point only. Any paraj baat chali rahi hai. Company to LLP possible, but you asked LLP to firm, which is not mentioned in the Act.
Both I had asked.
Okay, no, this is possible. This is mentioned in the Act envisage, even Income Tax Act also envisage this
But
situation.
in that case, the whole shareholders or the members of the partner,
Compulsorily required to be the partner.
they are required to be a member of LLP.
That is what is the condition mentioned. Tax exemption when you are converting from one firm to the another, that is firm to LLP or company to LLP. This is section 47, Roman 13, small b. This section gives the benefit and beneficial section, wherein on the conversion of firm to LLP or company into the LLP, the tax liability or the tax incidence is not going to arise. But what are the conditions? This is again, you need to understand that the condition for the availing the exemption, you need to comply with all the conditions. They are all cumulative, and if it is it is over and above some of the conditions, over and above the LLP Act, you will have to continue to comply with it. I am repeating the word, you have to continue to comply with it, then and then only you can have the benefit. Why I am using the word continue? Because if you look at the conditions, you will find out that is over a period of time. All assets and liabilities are required to be taken over by the LLP. Their capital contributions are in the same proportion as their shareholding in the company. These words are not used in the LLP Act. So you need to understand that it is required to be in the same proportion. Shareholder of the company do not receive any consideration on conversion other than shares in profit and capital contribution in LLP. Supposing they get shares as well as they get some cash compensation by way of a check or maybe some asset, not allowed. Then you are not meeting with the condition and that exemption is not available. Partners are not paid any amount from accumulated profits of the company for 3 years from the conversion date. So this is very important. That is what I told you. You have to continue to comply with the condition. You have to meet the criteria even at a later date as well. Condition continues. Total of the profit sharing ratio of the shareholders company should not fall below 50% for 5 consecutive years. 5 વર્ષ સુધી આ profit sharing ratio should remain same. You cannot change it so far as 50% is concerned. Between those 3, 4 partners or 10 partners, that 50% can be vary. So that is what I am saying. It is required to be seen in aggregate and not individually. Among those 5 partners, if they remain 50%, there is no problem. Shareholder can retire from LLP. So what happens that there are, let me repeat, see this is very typical case of being a teacher. I will try to give you an illustration. There is a partner A, B, C and D, 4 partners are, 4 shareholders are there in the company ABCD Limited. Company got converted into the LLP. On the date of the conversion, A, B, C and D has to be, all 4 has to be a partner. On the date of the conversion, all 4 have to be a partner. After the conversion, D can retire. But supposing D is holding very huge amount of the ratio and E is admitted and E is taking over 51%, then this condition is not met with 50%. So you need to understand that how this is required. Between inter se, those 50% is managed and that condition is met with. Can shareholder assign his share of profit and continues to remain a partner vis-a-vis the firm? My answer is yes. Shareholder can assign a share of profit. What is condition prescribed in the act is that he has to be a partner. Right? I think you have a question. Yeah.
If these shares transfer to his legal heir, then?
On the date of the conversion,
No, afterwards.
then there is no problem. Conversion, but if it is changing 50%, yeah, it will be a challenge.
No, but D was partner, D has died and his shares transferred to legal heir.
No, I don't think that the condition is met with. Because the condition prescribes, see, somehow you will have to ensure that he becomes 49% partner and then 2% is transferred to A, B and C. Then that condition of 50% with the old partners in then company remained complied with. Because legal heir does not step into these shoes. This is what is my opinion. Siddhar bhai?
I think there would be some dispute around this.
It is a controversial, but
What is your
It's a
opinion?
debatable issue.
debatable check.
Chintan,
To my
what is
mind,
your opinion?
position should also be possible. Legal heirs should be considered to be.
On death.
Depends on the agreement
But-
which
but
has been
then-
mentioned in LLP.
Then what Alok bhai is mentioning is also true that there could be some obligation.
Depends on the agreement of LLP.
Huh?
For
It
legal
doesn't
heirs-
depend on the agreement of LLP. It's based upon the probate law.
It's a probate you need to look at, not the LLP agreement. Because LLP agreement in any case will have always that clause that the legal heir will be entitled to have the share. But it is not going to help, in my personal opinion, because the shareholder, what they are mentioning is the shareholder.
But I guess successor
Variation बाकी
clause
है.
is there.
Further conditions on the conversion when you want to get the when you want to take the benefit, what you need to look at that the sales turnover or gross receipt in the business of the company should not have exceeded 60 lakhs in any of the 3 years preceding the year of conversion. Now these are all very funny and flimsy conditions which has been put in. but they want to ensure that the larger private limited companies don't get converted into the LLP. They want to ensure that. So this is the condition. I want to just give you an illustration. If supposing a company in the last 3 years, in one of the years they have a turnover of 100 lakhs, they will not be able to take the benefit of this. So I personally consider government આપવામાં બહુ કંજૂસ છે વિચારીને કે ભાઈ ના મારે આટલું જ આપવું છે. I don't know why this. Because see, many of the times now the cost of the compliance is increasing so much that in fact we recommend to some of the clients that it is better that you convert it into the a smaller form of organization like LLP, and that will benefit you. But the government is not. Total value of the assets. Now this is the additional condition which has been put in, and which is again very funny, which has come with the effect from 1st April 2017. That is the last budget, wherein it was announced that it should not exceed more than 5 crores. Now this is a pauser. Whether interest, dividend, rent form part of the total turnover or a gross receipt for investment company, I think the obvious answer is yes, that it will form a part of the turnover. But supposing if it is not an investment company, then in my opinion, the turnover definition would exclude the interest and the rent both. If it is a manufacturing company and just because of the incidents, there is some amount of the fixed deposit lying in the bank, that amount cannot form a part of the turnover. For property holding company, rent would obviously be forming a part of the turnover. Merging company to be also considered if merger in the last 3 years or in the same year. In my personal opinion, when there is a merger, one of the companies ceases to exit, and therefore the consolidated merged turnover should be taken for the purpose of arriving at. Because what is getting merged is that merged company. Supposing there is a company ABC Private Limited, there is a company PQR Private Limited before 4 years. In the last 1 year, ABC Private Limited got merged with the PQR Limited. In my opinion, from that time onwards, the merged turnover has to be taken. But before that, you don't have to merge off that earlier turnover. So we need to look at the ceiling from the merged turnover from the date of the merger or from the year of the merger. Further condition, partners are not paid any amount directly or indirectly from the accumulated profit. The word used in the act is the word used in the act. Directly or indirectly, and this is very important because the case law which I am planning to take up has a direct bearing on this particular word, directly or indirectly. What is keep aside accumulated profit? Only the current remuneration, interest and share of the profit to be drawn, not beyond that. Accumulated profit, when I was looking at the definition, is not defined. So my personal opinion is that basically when we talk about an accumulated profit, it is profit available for the distribution to the shareholder, because these we are talking about a conversion of a company into the LLP. So we have to exclude the share premium, in my opinion, the revaluation reserve, and maybe any other capital receipt, including subsidy or a capital reserve. No prohibition on withdrawal of capital. Now this is very important. See, sometimes what happens that we try to read a very strict interpretation. Partners are not paid directly or indirectly. Paid because once you are having an LLP, it would be just like any other partnership firm. So in a partnership firm, partner is entitled to withdraw his capital. So he can definitely withdraw the capital. But to the extent of the amount of the accumulated profit, if he is trying to withdraw over and above, supposing the capital standing in the books of account is 1 crore and the accumulated profit is 50 lakhs, if he is withdrawing 1 crore 25 lakhs, then the problem would arise that 25 lakhs is out of the accumulated profit, right? Now there are certain issues which are possible if any of the above conditions are not satisfied subsequently. such conversion shall be chargeable to tax in the hands of the successor. Successor is now LLP. So it will be taxable in the hands of the LLP as if they have not complied with the condition, and that is being envisaged in section 47 capital A clause 4. Deemed to be profit and gains of a business. In my opinion, it will not be basically a capital gain, but it will be deemed to be a profit and gains chargeable to tax. Profit and gains arising from transfer of such capital asset not chargeable under section 45. Because it is already now charging, being a business income, it will not be chargeable as a capital gain. Now this particular point will be more clear once we will discuss about the case law, which is immediately after this slide. If the conditions are not satisfied, capital gains is not exempt. Applicability of the ratio of the Bombay High Court in CIT versus Taxpin, engineering and manufacturing works. What would be the consideration for transferor company? It is going to be basically the capital contribution in the account of the partners of the LLP. Whether it will be deemed as a dividend, in my answer no, because on the date of the transfer, the company ceases to exist, and the new form of organization coming into the play, that is LLP. LLP per se have no direct nexus with the 222E, which is deemed dividend. So deemed dividend clause will not apply over here. Because see, we will have to think from that angle as well, because tomorrow supposing partner withdraw the capital, the problem would come that this is a basically amount withdrawal out of the accumulated profit, though it is less than the amount of the capital. Would capital gain arise in the hands of the shareholder, exchange of the shares for the capital? Answer is no, because that is what is the benefit which is cast, or it is just a succession which is happening. So the answer is no. Amount credited to the capital account of the partners is a consideration. Yes, it is a consideration, but per se, from the income tax angle, the transfer is not taking place. So the question of the consideration passes from the transferor to the transferee, does not arise, and therefore it will not be considered as a capital gain. Separate PAN, here I am talking about ABC Private Limited and ABC LLP. Both are required to have the separate PAN, and 2 separate returns in the year of conversion is required to be filed. Conversion of LLP into the other tax aspect, that is 72A, which is basically about the accumulated losses and unabsorbed depreciation. Company deemed to be ceased to exist, and the loss and depreciation of LLP for the purpose of the previous year in which the business reorganization is affected. You get 8 years period from the following year of conversion. You get fresh lease, additional number of years are available, so you will have to start afresh. What losses get carried forward is the same, except in the case when the partner retires or dies, then to that extent that proportionate loss you will not be allowed to set off or carry forward, right? Supposing there are 4 partners each having equal share, then 25% of the losses would be done away with. Conditions are violated after the set off of losses. Once the losses are set off, later on the conditions are violated, it does not entitle the assessing officer to reopen that case, because on the date of the setting off, the condition is required to be met with, and once that condition is met with, you are entitled for the set off of the losses. In the later year, what is not entitled is the withdrawal of the original exemption given, and that will be put to the tax in the year when the condition is violated. Lapsing of the MAT credit, I think that is very obvious. I think Chintan bhai covered that the MAT credit will be lost because there is a complete change of the entity from a private limited company to the firm. Unlike in case of a firm to LLP, the type of the entity and the section itself is basically the same which is applicable. So in my opinion, that is what the continuity advantage you will have, but here the MAT credit will be lost. Now this is a case study of the Aravalli Polymers LLP versus JCIT, which is a very classical case. We try to understand the case. Aravalli Polymers LLP was formed on conversion of the company into LLP. Post conversion, but in the same year, the SSE gave interest-free loan. थोड़ी कुतावड़ करी ना क्या interest-free loans to its partner in the profit share. See, basically, why we need to understand this case, because maybe it might have gone with a lot of planning. The consultant must have advised that there is a loophole, and that is what I was trying to share with you. That sometimes we consider it as a loophole, or there is a hole, but there is no loophole at all. And we try to plunge into it, and we find that there is a big ditch, and the SSE falls into it. And now with a lot of changes coming into the Income Tax Act, wherein even the consultant's personal liability is going to be also coming into the play. So it is very important for us not to have the very adventurous and the aggressive tax planning. This is a classical example of a fantastic tax planning per se. But I personally feel that there are a lot of gaps which has happened, and therefore the case fall into the problem. The SSE gave interest-free loan to its partner in the profit sharing ratio, partially out of the accumulated profits standing in the accounts of the company on the date of the conversion, or maybe after the date of the conversion, immediately after the date of the conversion. The SSE sold the shares held in the listed company, which vested it upon the conversion and earned a capital gain. The amount involved was very huge. Almost about 50 crores worth of the shares of the listed company East India Hotels were being held by this particular company. The cost of the shares were few crores, 1 or 2 crores, and the huge amount of the capital gain to the extent of 45 crores was there. See, I don't know. I'm trying to make it explicit, though I know that I'm dealing with the chartered accountant who are aware about it. But why many companies, they are started planning to get converted into the LLP? One of the reason was, at that point in time, in fact, that benefit was available, was a dividend distribution tax, which is still as on date is not applicable in case of a limited liability partnership. I am repeating again. Dividend distribution tax, DDT, is still not applicable to a LLP. Earlier there were two major benefits were available. One was the MAT and another was the dividend distribution tax. But now still the dividend distribution tax is available. Now what was happening and why this planning must have been done, I am trying to envisage. Somebody may add it even. That the huge amount of the capital was blocked in the form of a listed company shares, which they wanted in any case to sell for the purpose of the liquidity. And that the amount they want to distribute among the shareholders. But they could not do it because once they sell the shares, the capital gain tax liability would come. After paying the capital gain tax liability, when they want to distribute either in the form of the distribution of the dividend or maybe on the winding up of the company, the dividend distribution tax liability would come. It is almost to the extent of 20%. Now they want to save on that. That is what is my assumption. And based on that, the tax advisor must have done it. So, see, sometimes what happens that we think that why they should do it, this must be the logic. And the share value is very huge, so they must have done it for the purpose of distributing that amount. What they did, that on the date of the conversion, they sold the shares. So the amount was lying in the bank account. The capital gain, in any case, they have to pay either the LLP pays or the company pays. It is the same. And that was no tax liability. One, it is a long term. Right? Once it is a long term, there is no liability. That amount was lying. So on the date of the conversion, the things were bank balance 50 crores and the partner's capital account and a profit. Now, immediately or on the date of the conversion, they advance this loan interest free in the profit sharing ratio, that too. And that is what is the observation of the tribunal as well. In the profit sharing ratio to all the shareholders at that point in time, later on who became a partner. So this is a story in the background to understand the case. And as they wanted to take the benefit of 4713B, naturally on the conversion there is no tax. And the partners were enjoying that liquidity because that was an interest-free loan available. So as per one of the conditions mentioned, which exempts the capital gains arising to company and its shareholders on account of the conversion of company into LLP, no amount to be paid either directly or indirectly. That is what I told you. The word directly or indirectly is very important. To any of the partner out of the balance of accumulated profit. What is that accumulated profit? That capital gain, 47 crores. In the company's account on the date of the conversion for a period of 3 years from the date of conversion. Right? That is why I told you that ઉતાવળ કરી નાખી થોડી. જો લોકો 3 વર્ષ wait કર્યો હોત, so then this clause, or I'm sorry, that this particular non-compliance would not have got attracted. They would have continued to comply with. What is the tribunal's ruling? It is a Calcutta tribunal ruling. The grant of the interest-free loan to partners in the profit-sharing ratio, partially out of the accumulated profit, existing on the date of the conversion, resulted in breach of one of the conditions of the exemption. We have seen those conditions. Those conditions are very specific, directly or indirectly. Directly word means they have withdrawn the capital amount over and above their capital account balance. Indirectly means interest-free loan. That is how the tribunal interpreted the whole situation. The breach took place in the same year. એ લોકો એટલી બધી ઉતાવળ કરી દીધી કે જે દિવસે વેચ્યા ને એ દિવસે લોન આપી દીધી કન્વર્ઝનના દિવસે. They must be in very much hurry. So sometimes we say that haste make waste. So classical example. By virtue of which the exemption was never available. See, the judgment is very important. The tribunal observed that the benefit was never available itself. See, there is two situations. One, you try to understand that on the date of the conversion, if everything is complied with, they would not have given a loan or advance to the shareholders in the same financial year. The 4713B is available. And then the non-compliance would happen, and then the implication would have been little different. Here the implications are more serious. EO computed capital gains by adopting a market value of these shares on the date of the conversion as per section 47A4. The tribunal said that even 47A4 will not come into the play, because 47A4 would be available only when there is a violation of the condition. The tribunal said that in the first place you are not entitled because you have not complied with the condition in the same financial year. So basically, it applies to a case where the exemption is available and the condition laid down in the proviso are not complied with. However, the assessment here under the consideration is the same in which the conversion took place and conditions are violated. So, what the tribunal held? That under section 45, the market value of the assets transferred cannot be deemed to be the capital gain. Deemed to be the consideration. Capital gain cannot be computed on the basis of the market value of the assets on the date of the conversion, but should be computed on the basis of the actual value at which assets are transferred. If the assets are transferred at the book value, still you can take that liberty and section 45 section 45 wherein you will have the chance of getting, because these are succession, and succession having the exception wherein this will not be considered as a transfer under section 2 subsection 47, because when the company form of organization get converted into the LLP or firm into the LLP, then basically you have the exception, and that you are allowed to carry forward or carry it over with the value which is available in the book. So tribunal gave a direction to the tax authority to compute the capital gains by adopting the figure at which the assets of the predecessor company were actually acquired. Right? So this was basically about the very classical case wherein the tribunal take a view where the conditions of the section of the 4714B is not complied with. Now what are the rates of the tax? Just for your information, LLP are liable to pay the same rate of tax as that of the firm. So 30% plus education cess plus surcharge plus secondary and higher education cess, surcharge in case when the profit is more than 1 crore, short term capital gain at 15% if it is listed, long term capital gain 112 20%, alternate minimum tax which is applicable 115 JC at 18.5%, dividend distribution tax is not applicable. So this can be one of the main reasons why we should suggest to those companies which is very closely held and they want to keep on distributing the cash flow among the shareholder or among the partners to go for the LLP. So I personally feel that still you have one reason to be advocating the LLP form of organization as a better form than the private limited company in the given situation, wherein you are planning to keep on distributing the cash flow, not otherwise, because every form has its own advantages. Audits. Under section 44AB, the turnover or gross receipts exceeding 1 crore with effect from 1340. Partnership firm are not subject to the audit under Partnership Act 1932, but unlike that, LLP Act mentions, LLP Act 2008 very clearly mentions where the ceiling is different, and here some of us can miss out, and therefore I have deliberately taken this particular slide, that when your turnover is more than 40 lakhs, capital contribution not less than 25 lakhs, and you are subject to the audit under the LLP Act. Now one question or one pauser which I have is that, supposing a firm, an LLP having a turnover of 10 crore approaches you for the audit and you have completed the audit, the format of the tax audit report, 3CD in any case is common, but 3CA and 3CB, which format you will use, because sometimes we might be misunderstanding and using a wrong format. No, then it would be inappropriate because you are supposed to use the 3CA. If you look at the 3CA, it clearly states that if you are subject to the audit under any other statute, then you are supposed to use the format 3CA. And in my opinion, when you are subject to the audit under the LLP Act 2008, you are supposed to use the format 3CA and not 3CB. This is what is my personal opinion. Right? Okay. Due date of the filing of the return would remain the same. In case of the LLP subject to the transfer pricing audit, 30th November, and if it is subject to the audit, either under the LLP Act or maybe under the Income Tax Act or any other law for the timing in force, 30th September, and for other firms it is 31st July. With effect from assessment year 6-7, it is mandatory for a firm to file in return of income irrespective of whether they have a taxable income or not. So LLP being a firm for all purposes under the Income Tax Act, it is mandatory for them to file a return even if they have a zero income, no income or negative income. Introduction of asset into the LLP. Section 45, subsection 3, transfer of capital asset by a firm, by a partner to firm is chargeable in the year in which the transfer takes place, and amount recorded as a value of capital asset deemed to be the full value of the consideration. If somebody was asking a question, supposing I want to introduce land as a capital. When you are transferring the asset as a capital into the firm, on the date of the transfer, it will be considered, on the date of the formation of the LLP, when you are inducting that asset, that will be considered as a transfer and you are subject to the capital gain tax. Maybe somebody may plan it out in this manner, wherein that capital asset should be converted into the stock in trade in his personal balance sheet, and from that he can transfer it to the firm, and then you can get away with that liability to be paid immediately. So just to give you one small example, I thought that let me share some tips which I understand can be very easily applied. Supposing a person is having a land as a personal asset costing or having a document value of 50 lakhs. On the date on which he want to introduce it into the firm, the fair market value is, let us say, 1 crore 50 lakhs. So 1 crore is a profit which he would have otherwise attracted and he would have paid the capital gain tax. What he can do, he can convert these assets into the capital asset in his personal balance sheet if he is a businessman, and then he introduce the same stock in trade as his capital into the firm. On the date of the transfer, basically, as it is getting transferred at the same value, it will not be considered as a transfer, because finally when it is getting transferred only on that date, conversion of capital asset into stock in trade benefit you will be able to get. This is what is my personal view. Section 32 of the LLP Act, read with Rule 23(2), whether necessary to introduce at a market value. The Act specifies that it is required to be valued by a chartered accountant or a cost accountant or a valuer if you are introducing it in either movable or immovable asset other than the cash. A market value may not be a very appropriate word, but in my personal opinion it will be a fair value, because in any case you will have to get it valued. You cannot just put any value, because you need to have this certificate, because that is mandated by the Act that you have to get it valued. So market value exactly may not be necessary, but fair value in any case would be essential. Applicability of section 50C where asset is an immovable property, answer is obviously yes. Section 45(3) and section 50C both are deeming fiction and full value of the consideration. Whether both deeming fiction can be applied on one deeming fiction, the other deeming fiction, I would say yes, because the Act envisages that. So on one deeming fiction you can create another deeming fiction. Applicability of the section 56(2)(7)(a) where asset is a shares of a closely held company. Again, if you are transferring it at a lower value, then section 56(2)(7)(a) will get hit. Assignment of the shares in LLP by a partner. I think we are out of the time. Should I complete in 5 minutes? I'll take this. Merger of LLP. Supposing the two LLP gets merged. Section 62 of the LLP Act 2008, 10 is added by mistake. This 20,008 is still very far off. Amalgamation or reconstruction of the LLP, it can be done with the approval of the NCLT, National Company Law Tribunal, now which is formed. NCLT may make a provision for the transfer to the transferee LLP of the whole or any part of the undertaking, property or liabilities. Whether it can be exempt under section 47, there is no specific exemption. Whether it can be treated as a slum sale, if the whole of the undertaking is transferred, in my opinion, it can be considered as a slum sale. And if the conditions mentioned of the slum sale under section 2, subsection 42C, where the transfer of one or more of the undertaking is the resulting the sale for the lump sum consideration without value being assigned, it can be considered as a slum sale. Recovery of the tax. There is one difference between the firm and the LLP. If you look at the section which is applicable for the recovery of the tax for a partnership firm is section 188A, which clearly mentions that every person who was a partner of the firm during a previous year in which that tax liability arose, then he is personally also liable, jointly and severally liable along with the firm for the amount of the tax or the other sum payable by the firm. In case of an LLP, that applicable section is section 167 capital C, where the tax is due. The same wordings are there, except if you see, unless he proves that the non-recovery cannot be attributed to his gross neglect, misfeasance, or breach of duty on his part in relation to the affairs of the LLP, he can do away with the liability even at a later date also. So sometime maybe when you have an LLP, one of the partner retires, at a later date, supposing some tax liability is not paid by then continuing partner or with the new partners added at a later date, then the retiring partner can avoid his responsibility or liability for the payment of a tax at a later date, or he cannot be called upon to face or pay that liability because of the reason, or with the logic or with the documents he proves that he is innocent and he had no role to avoid the tax. So the last slide which you would like the most. Thank you. Thank you very much.
Is there any restriction on accepting or giving loan or deposit by LLP?
No. No.
Like company?
No. There is no. There is none, I would say. LLP can take any amount of the loan from anybody.
And give also?
Yeah. Thank you, everybody. Yeah.
As in case of Aravali, there was an interest-free loan.
Right.
But if it had been an interest-bearing loan, then also will it be covered in indirect?
I think then they might have taken the view of the McDowell, wherein they would say it is a colorable device or something of that sort. So income tax department can go with any angle now. You have a Vodafone also. So I personally feel that it is better not to take a chance, even for the interest-bearing loan also. And specifically, see, as I have told you, they committed many mistakes, and one such mistake can be, exactly giving a loan in the profit-sharing ratio, giving interest-free in the same year, as if they were just waiting for this to happen, like that. So I personally feel it is a classical example when you are using too much of the tax planning, or if it is very aggressive tax planning. This is what is personally I believe. And maybe still you have a little stronger case when you are giving interest bearing. But I doubt, maybe you can change the structure, or somebody may suggest, I am not suggesting, please don't take it my suggestion, that you give a loan to somebody else, a relative of the shareholder. Some of that goes. This is not my suggestion. Please don't quote me. But some of these things can be taken help of. Thank you.
Sir, if firm has availed some loan from a bank,
Right.
and now it is getting converted into LLP, so banker's NOC is required?
NOC may not be required, but the bankers would generally have, not generally, bankers छोटी-छोटी उसमें font में बहुत सारी चीजें लिखी होती है. And if you read it, any reorganization,
Reconstitution.
so Act don't require. Let me tell you, if you are asking
So it is
LLP
based on
Act,
that agreement.
LLP Act,
Loan agreement.
no. But you are bound by that loan
Loan
agreement.
agreement.
And loan में font size
clause
इतनी
would be
छोटी
there.
होती है. And I tell you, we missed out. We missed out. In fact, if you ask me on the lighter side, बैंक की लोन के डॉक्यूमेंट में इतनी सारी चीजें होती है कि अगर उसको practically, even if you know somebody was asking giving a loan to this to the other party, even you require that permission because they are writing diversion. They don't look at it. A classical example is, now you have the McDowell again companies like Malia. They close the eyes when they want. Right? Thank you once again. I enjoyed talking with all of you. It was a pleasure, and I thank once again the branch and all the office bearer to give me this opportunity to be amongst the professional brothers. Thank you and good day.
The topic for this session on LLP is generally considered a very dry topic by most of the chartered accountants, and as is evident from the strength that is there for the second session, there are many who not come, but many of them who were there for the first session are not present now, thinking that LLP is a very dry subject and dry topic. I guess the loss is completely theirs because what we have gained from today's session is just phenomenal. And the second benefit that we have got is the benefit of the expertise of the knowledge of the speaker for today and his being an academician, because the way he carried out the entire session, right from A to Z, right from the basics and then to the finer aspects, was very lucid and made the topic very lucid, interesting, and very we enjoyed it thoroughly. So that benefit also we have got, which the others have missed out. Just like LLP is a beautiful blend to get the benefit of a partnership firm and the Companies Act. Similarly, the speaker for today is a beautiful blend of intelligence and knowledge along with humility and modesty, which makes him a true professional, and we have gained with that also. Thank you very much, sir, for enlightening us on this topic and giving us a wonderful session. And we are confident like we'll be seeing, hearing you more often on any topic that you find close to your heart. And
suggest the branch for another
certainly suggest a topic and we'll talk to sir. Sir, whichever topic you are comfortable with, we would love to hear you, and whenever it's your convenience. So on behalf of all the members present here, I would love to give a hearty vote of thanks to sir. Let us all put our hands together.